Yep.
All good?
Yeah.
Okay, so let's start the 8 p.m. session for the first Thursday gathering. Tonight is Catalytic Capital, Impact and Sustainability Investing, presented by 1.5, and I would like to welcome the wonderful speakers today. And Matthias is moderating the sessions. The floor is all yours.
Thank you so much, Lisa. Welcome all viewers from Venture Cafe Tokyo and those that have joined us from around the world to this exciting hour of discussion where we deep dive into understanding more about impact and sustainability investing as a way to drive catalytic change. My name is Matthias Muehlbauer, your moderator today. I'm a consultant and impact investor at 1.5, speaking from the early morning hours in New York. Right now, I have some incredible guests to introduce you today who are experts on the topic and will bring perspectives from the US, Southeast Asia, and Japan. In the chat below, I'd love to get a gauge of where a virtual audience is from, and know people are joining as we continue. I'd love to know what you'd like to get from the session. So if you can just state where you are and a few words on what you're looking for from today's session, that would be fantastic. And whilst that's happening, let's get to know the panelists. I'd like to invite our three guests to give a 30-second introduction, including where you're speaking from, and a quick summary about yourself for people tuning in. I'd first like to introduce our first speaker, Yeoh, founder and CEO of advisory firm 1.5, ex-Echoing Green climate investor and fellow Yale alum. Thank you for joining us today.
Great, thank you so much, Matthias. It's great to join all of you. And as Matthias says, I have several hats these days, a lot in terms of climate change advisory, investing, and also in terms of the content creation. Looking forward to being on this panel and sharing what I know from, I guess, the multidisciplinary aspects of not just the funding, but actually the execution of the work. Thanks.
Fantastic. Thanks for the introduction, Neil. Second, I'd love to introduce our second speaker, Shuyin Tang, co-founder and CEO of the Beacon Fund and partner at Patamar Capital. Shuyin was named one of Australia's 100 Women of Influence by the Australian Financial Review in 2015 and an Asia 21 Young Leader by the Asia Society in 2016. Thank you so much for joining us today, Shuyin.
Thanks a lot, and it's such a pleasure to be here. I'm joining from Ho Chi Minh City, Vietnam, and I have been in Vietnam for 8 years now. It's hard to believe, and doing impact investing for all of that time that I've spent here. A fun fact is that Yoshi-san, another one of our panelists, used to work together back in the day, and we had some great times together at LGT Impact, the impact investing firm. So today, though, I'm a partner at Patamar Capital. As Matthias mentioned, we're a regional impact investing firm focused on Southeast Asia. We run a number of different funds on our platform. So some of them are more like impact venture capital funds. That's Patamar 1, Patamar 2. More recently, we've launched a new fund called Beacon, which I'll be sharing a little bit more about later. But overall, we've made about 20 investments in the region, have about $100 million in assets under management. Back to you, Matthias.
Thank you so much for that incredible introduction. And finally, last but not least, it's my pleasure to introduce our third speaker, one of the early impact investors from Japan, Tabuchi Yoshitaka, co-lead of Tokyo's chapter of Zebras Unite and founder and CEO of advisory firm Envisage. Thank you so much for joining us today.
Thank you very much. It's such a pleasure to be here. I am based in Tokyo, Japan. I've been in the impact investing sector for about 7-8 years since when I met Shuyin for the first time in Southeast Asia. Came back to Japan about 5 years ago and been in Japan, Tokyo since then. I run an advisory firm called Envisage now, where I work with the foundation that practices impact investing here in Japan. And I also work with some of the startup companies for supporting their management team and sometimes on the teams on the ground. I also started an organization called Tokyo Zebras Unite. I'm gonna explain a bit more details about this organization later. But basically, it's an organization to talk about the new concept called Zebra. And I'm the one who is trying to expand this concept in Japan. And I'm also planning investment practices here in Zebra companies. Thank you.
Fantastic. Thank you so much for introducing all yourselves, panelists. And just seeing that we have quite a few more people that have joined. If you can, in the chat, just write a little bit where you're tuning in from and what kind of objectives, things you'd like to learn about in this session. And we'll see if we can cover them throughout our hour. So before diving into discussion, as always is the case, it is important to define the terms we are speaking about today to allow everyone the same reference point. What is impact investing? What is sustainability? And what is catalytic change? By impact, we mean impact in terms of something outside of financial impact. We can use terms like ESG to cover the environment, social areas, and governance areas where impact is generated. In the impact investing world, we typically see a continuum of investing viewed through a lens of returns. On one end, we have a return of zero with maximum impact. Foundations and philanthropic organizations typically sit on this side of the spectrum and provide grants to organizations to achieve non-financial outcomes without a return. On the other end of the spectrum, we can find impact investing with a market rate of return that you'd normally expect for any other fund. At the same time, we also have impact. This side of the spectrum is a side that a lot of people have been skeptical about, but more and more we are seeing that it is possible to do good and gain a market rate of return. Impact venture capital is an example of this side of the spectrum. And of course, in the middle, we have venture philanthropy, which trades off between market rate returns and the amount of impact. The meaning behind sustainability is typically determined by the context, with lots of instances of greenwashing from companies. Prevalent today, this term can be used to virtue signal, but at its core, it refers to meeting the needs of today without compromising the needs of the future. It can also refer to the ethical and careful use of resources within an environmental context without harming the environment. We will use both definitions in today's discussion. And finally, catalytic change. By this term, we refer to measures that enable, facilitate, accelerate various mechanisms that drive change. In our discussion today, we talk about how impact and sustainability investing will drive that change. Our objectives today will be to examine a few different ways in catalyzing change through an impact and sustainability investing lens. Ideally, we will be able to find ideas that can be applied within a Japan context or your own country's context. Right, so let's jump into discussion. Shuyin, speaking of catalytic change, I spoke to you earlier in the year around June, and you were midway through preparing to launch Beacon Fund in Vietnam. First of all, congratulations on an incredible achievement. What's different with your newly launched fund, and why should people be excited about it?
Thanks. Yeah, I was just reflecting on this before we hopped on, and in some ways it's a little bit ironic that I'm a speaker here today at a Venture Cafe meetup, because I think one of the biggest learnings that I've had, which has actually culminated in the Beacon Fund, is that VC isn't for everyone. And don't get me wrong, and please don't be offended. I've been a VC myself for almost a decade, and I still love wearing my VC hat. But over the past 3 years or so, I would say, especially, I've realized that the VC approach does miss out on supporting a lot of highly impactful and also, highly financially attractive companies as well. And maybe just to share the story of how I had my aha moment in this regard was when I was considering the question of why female entrepreneurs aren't getting funded in Southeast Asia. So that's a question which I'm super passionate about, as anyone would tell you. And I think as I was thinking about this issue, I realized that so many of the female entrepreneurs I met were running great businesses with great fundamentals, solid unit economics. But then in terms of this exponential growth profile that venture capital basically demands, right? they weren't a good fit for that, right? And I think for those of you who are in the venture space yourself, I think you know that venture is all about finding unicorns, and this kind of home run, this big exit, big kind of $1 billion type of exit. I think the reality is most companies don't actually fit into the profile, right? I think particularly and often when they're working in the social impact space, right? It's not to say that there aren't some which can have that, really outsized returns, outsized scalability. But I think what we noticed was that many don't actually fit into that profile, and there's not actually much funding available for them. So they don't fit that profile of venture capital. They're too small for private equity. They're too big for microfinance or some of these other fintech lending platforms. So they're really a bit stuck. And I think why we decided to launch the Beacon Fund at this time was to fill that gap and that kind of missing middle. So one of the I guess more interesting things and differentiated things about this fund is that it's actually a debt fund, or focused more on debt products. There's so much focus on equity through venture capital and private equity approaches, but actually in many cases debt can actually be a better fit for these companies, right, which are cash flow positive, growing steadily, and don't necessarily have an exit in mind. And I think it was really fascinating for me as I got into this further to see that how small the private credit market is in Southeast Asia. So I think 90% of financing or of debt financing in Southeast Asia comes through the banks, right? Whereas in other markets, developed markets, it's more like 50%. And this was kind of like, wow, there's a huge gap here, because I think, as many of you would appreciate, the SME banking sector in Southeast Asia, particularly emerging Southeast Asia, is pretty underdeveloped, right? And has all kinds of different hurdles, such as collateralization, difficult processes, relies on existing relationships. So that's just like in a nutshell, I think, why we started the Beacon Fund. I think one of the first private credit funds in Southeast Asia, and I think also the first, I would say, explicitly focused on female entrepreneurs. We see, a lot of opportunity here, and are really excited about, making our first investments and proving out our model.
Thanks for that. And just jumping a bit deeper there, how does an evergreen fund differ to a normal fund? From what I understand, Beacon Fund is an evergreen fund. What kind of different outcomes do you expect that to drive? And perhaps this might connect to your female founder focus. How does that relate there as well?
Yeah, I'm really glad you asked this question, because I think one of the other big learnings that we've had, apart from, I think venture capital isn't a great fit for everyone, is that, the 10-year fund life, which is the way most venture capital and private equity funds are structured, is pretty artificial, right? I think especially in the impact space, I think we all know that most of the problems we're trying to solve are really, require a long-term view. And I think this one that we're trying to solve is no different. So I think that's why we decided to set up, sometimes it's called an evergreen fund, an open-ended fund, a permanent capital structure. There's many different names for this. But I think that the idea here is, building up a investment vehicle which really lasts for the long term, right? And I think, how do we do that in a way which is still attractive for investors? So the answer here is that, because our underlying assets are actually primarily debt, that means that we're lending out money, and we're also getting reflows back, right? Repayments back all the time. So that actually means that our vehicle itself can be sustainable and profitable. And again, I think that's a big difference from the typical venture capital or private equity fund, where you're looking for, exits in years 8, 9, 10, and often much longer, as the case may often be. So I think the difference here is that, as a vehicle, we're actually profitable, honestly, from almost years like 1 or 2, right? And I think we can really grow that capital base over time and have some of the flexibility we need to solve some of these longer term social problems that we're passionate about tackling.
To sort of draw the thread through there, it feels like you're sort of aligning your incentives with your sort of investment targets much better than a traditional VC firm would have, especially these sort of longer sustainable businesses.
I think that's another part of it, right? Because I think, I think one thing that we've seen, also having managed, a number of different venture capital funds, is that, often there's this quest for, I think for AUM, right? And I think raising successively larger funds Whereas, I think smaller ticket sizes, right, and really serving this missing middle is I think a huge part of doing kind of the impactful, or at least what I see as like highly impactful investing in the region. So I think in terms of manager incentives, it's a really important question. We've actually moved away from a traditional like 2 and 20 structure. I think for those who are in the industry, they would know this this jargon, but so typically, just for everyone's kind of background, I mean, typically in a venture capital or private equity fund, there's a 2% management fee, which is charged, right? We're moving away from that. We're actually charging our investors what it costs to run the fund. So it's, in our opinion, a much more transparent approach. As for the incentives, we're really doing more of a profit sharing model than kind of the typical like carry on a private equity or venture capital fund. So I think, again, the incentives are aligned there in that, we're holding ourselves accountable to actually generate, a profit and a return as a fund, and really building that out over a longer term period, I would say. So I think, I think incentives alignment is so important. I think the other piece here is that we're also having impact targets, which we have to achieve to meet some of our payouts as far as our manager incentives are concerned. I think that's an innovation that we're seeing. I think I wouldn't say a lot in the impact space, but I think there's beginning to be some examples of this. And I think that's, again, really important in showing that it's not just about the financial return, but that the impact is critically important as well.
I might put a pin in that discussion in terms of impact targets and bring Neil into that a bit later, because I know some of your work has covered this sort of area of measurement and impact. But I might actually invite Yoshi-san into the conversation and sort of compare and contrast your experience. Now, speaking with you a month ago, we actually spoke at length about the work you're doing with zebras, or what Shuyin might have mentioned, the missing middle, and this approach to investing in companies, and this potential blue ocean of opportunity for investment. First of all, for those that are not familiar with your work as an impact investor in a trading company, so Sojitz, to becoming an impact investor, because that doesn't seem, in my experience, the traditional sort of career path of a person at a trading company. And then I'd love for you to share, for those that aren't quite familiar with zebras, could you explain what they are and what your focus is around investing?
Sure. Yeah, so like you said, I think I have two turning points in my life, in my career, right? I started with a company called Sojitz. It's a Japanese, one of the Japanese large conglomerate or trading firms. And there I was doing aviation finance, renewable energy finance. I was dealing with multi-million-dollar business. At some point, I started in a private. I started my community in Tokyo, where I was supporting people who have sort of a public messages. So, for example, artists, sometimes activists, sometimes singers, people like that. And so, on one hand, I was dealing with multi-million-dollars. On the other hand, I was dealing with maybe a couple $1,000s, but with some fulfillment, or the direct feedback from the communities. So sense of purpose, I would say. So I was back then. I was thinking how I can combine these two things. Then I found the concept of a social entrepreneurs or impact investing. So I decided first to learn about this concept, and I moved to Europe to go to business school, and I learned about social business impact investing. I think that's the first turning point when I changed my career from a traditional company to impact investing sector. So then I was doing impact investing, like I said, about 7 years. I was actually having a very similar problem awareness, as what Shuyin was saying. So I met a lot of entrepreneurs, right, to invest and also to do a management support. I kind of realized not every entrepreneur is needing a capital, a capital that venture capital is providing, or a capital that's mostly provided even in impact investing sector in Japan. VC investing is, well, I would say it's there are some companies that fits these profiles, so that's fine. But a lot of startup scenes, people are focusing on venture capital investment, trying to find a unicorn. Even in impact investing sector, people are trying to find a social unicorn, right? But if you, like Shuyin was saying, if you think about how many companies can be really a unicorn, it's a tiny percentage of the total number of the companies. But there are a lot of companies, entrepreneurs who is still profitable, who is still growing, who is doing a lot of meaningful work. They just have a different growth path than unicorns. So that was, that was a question I was having while I was doing impact investing. Then I met co-founders of the company called Zebras Unite. They are it's a US-based company. It's out of Oregon, and they have a similar concept. So they were also entrepreneurs, and they couldn't really raise a fund from venture capital in Silicon Valley because of the nature of their companies. But then they had the same question, and they thought something is wrong, right? There should be some different ecosystem for these majority of the companies. So they started this movement called Zebra Concept or Zebras Unite. And nowadays there are more than 60 chapters in the world. There are 6,500 people in the community.
Wow.
And I asked them to start this movement in Japan. So I started Tokyo Zebras Unite last December. So that's how I came to start Zebras Unite.
Amazing story there, and it's really interesting to see this movement of capital being invested differently across the world, and great that you've brought things from around the world back to Japan as well, and hopefully that can be a bit of a lens with which we talk about these stories today. How do we apply this in a Japan context, and how do we apply it to the country of your origin as well in that context? Now, we might bring in Neil. I'm sure he's sort of frothing at the bit to get a bit of action here. So as an impact investor at Echoing Green in the US, Neil, looking after a client portfolio, you've seen hundreds, maybe thousands of startups trying to solve climate change from all over the world. And now with 1.5, your new startup, you're also interacting with various sustainability startups and helping to deploy impact. What have you learned from your experiences about funding and building an ecosystem? And I guess the context with which this might be interesting for our audience members in Japan and around Asia and around the world. In Japan, we've seen the new Prime Minister Suga commit to reaching net zero carbon by 2050, like a lot of other countries, which of course is going to require an ecosystem to be funded and built. What can Japan learn from other markets in terms of building an ecosystem via catalytic capital?
Yeah, no, absolutely. Thanks for that multifaceted question. I'll try my best. But the real quick
it's a big question.
Yeah. But the quick background context for myself and the reason why I'm in this work is a relatively quick story. I mean, I grew up in Australia in an immigrant family. My parents were from Asia. My mom was from Shanghai as an immigrant in Hong Kong, and my dad was from Malaysia. And when they moved to Australia, they wanted a better life for us. And I was always connected to my Asian heritage, as many Asians on this call or other multicultural kids. If you don't look like the people around yourself, you generally try to find your own home culture. So I went to Asia and tried to learn Mandarin and Cantonese a bit better and experienced air pollution. And it kind of dawned on me as I was really interested in engineering and business and economics, how can we create, economies where we may not even have the basic right to fresh air because of the energy that we generate from fossil fuels. And like, mind you, I got into this debate before. Capitalism has provided a lot of benefits and standards of living that are amazing, and I don't want to doubt that. But also there are solutions, especially when it comes to impact, that we need to bring into the market, especially climate change, where we're dealing with limited energy, environment and resources. I really wanted to join that fight to perhaps bring in better solutions. And when innovation and technology, you need funding. And I thought funding would be relatively simple, but it's quite a multifaceted, complex area, depending on whatever region you're looking at it from. So I can definitely talk from the US side, who have obviously done this for a fair longer time. It doesn't mean that they do it any better, but there are multiple areas of funding that exist. And I'm going to be pulling from a report that I think Matthias will share the link from. I recently published a report with Yale University. It's called From Solutions to Scale, Considering Insights and Investing in Nascent Climate Technologies. But it is really kind of what the funding landscape is to bring the new innovations into the world. So the concept of, people didn't go around selling candles to bring light bulbs into the world, nor did they go around selling fossil fuel to bring solar energy and wind energy to the world. So how do we actually bring these solutions forward? The first thing I would say, in line with Shuyin and Yoshi in terms of funding, is that, again, venture capital is just one type of funding. And when it comes to risk tolerant patient capital, venture capital can be good for unicorns, but generally venture capital funds do not fund for R&D risk, market risk, or technology risk. So say, for example, you had a new innovation that could, hydrogen fuel cells, could create energy with the byproduct of water, and you went to a venture capital firm. I doubt that there's going to be a lot of hiccups when it comes to trying to bring an innovative solution from the lab to the marketplace. And that's why it's really important to have a portfolio of funding solutions, including what Yoshi and Shun's bringing. At Evergreen Green, we were a venture philanthropy, and we provided recoverable grants. And if those are not familiar with recoverable grants, is that we give a funding that basically, if a company does fail, it is forgivable and remains a grant. But if they succeed, whether it's a valuation or a certain profitability or revenue, then they would pay back the principal amount plus a bit of interest across a period of time. And so what that meant was, for our climate entrepreneurs, 40% of our portfolio actually triggered because of this forgivable grant. And it really puts the onus on the investor to make sure that they're choosing companies and are invested in their future, because it's 5 years from when they signed the contract. And 40% of them triggered our recoverable grant clause, meaning that for every dollar that we were given from philanthropy, we're able to extend the impact to roughly $1.40. And I think that concept has it's been around for a long time, but it's very surprising how it hasn't sort of propagated out further. Now, there are a whole bunch of other funding mechanisms, and you can read about it in some of the reports that I have, but there's mission-related investments, program-related investments coming out from the US, which allows philanthropy to fund even with some kind of debt funding. But it's extremely important to know the portfolio funding as an entrepreneur, but also as an investor, to learn from one another. But that's the second issue that I want to talk about, which is the ecosystem. Now, Asia is a very unique place, and I think there is a lot of growth and a lot of potential for impact. But just like any place, ecosystem is very difficult sometimes to build. So from, say, with the Aspen Network of Development Entrepreneurs, I know that they've been trying to build up an ecosystem in Southeast Asia through Thailand. Sustainable Finance Initiative, AVPN, they're trying to build up these ecosystems, whether from Hong Kong or to the wider Asia region. You may think that these membership organizations are kind of growing by the numbers, but they're really important. And the main reason why is that there's a lack of information share. So if I'm going to be completely transparent, Evergreen Green had huge learnings when it came to recoverable grants, which could benefit so many other venture philanthropy organizations. But there was still some kind of intellectual property when it came to building that investment instrument, that it was difficult for us to get permissions to share everything that we did underneath the hood for the funding opportunity. But in certain closed circles or with other investors, we're able to share a lot more about our lessons learned using these investment instruments so that they could either be applied to the way that we fund. And I think that's extremely important because we were finding other foundations trying to do equity investments and didn't have the capacity or the capability to do so. And so I think it's really important to actually understand the multi-level funding. And if Japan was to try and build up its own ecosystem, really learning from the lessons learned from other investors in other regions is extremely critical. And perhaps finding the right investment classes or instruments that have already been either tested or proven or that have had the bumps along the road, and talking to those investors to get those wireframes would be really helpful, knowing that obviously there'll be cultural contexts to sort of adjust it to. And the final thing is, when it comes to commercialization, getting an idea from the lab to the marketplace or from an idea to commercialization, there's a lot of bumps in the road. And so there needs to be a portfolio of funding solutions across the way. And in climate change, we call that the valley of death, in the sense that there are multiple valleys of death that you need to bypass when you go from a business that is generating $0 to a couple 100,000 to million to multi-million. Each of those steps requires maybe different types of funding. And we call it obviously the capital stack generally when you're a for-profit entity. And I believe that when it comes to Asia, I've seen a lot more younger startups very struggle with getting the early stage funding because a lot of investors are still catching up with the mindset of what impact investing truly is. And I saw the chat kind of mention a bit of greenwashing. There's other things like profiteering. There is this concept, especially with our startups from China, who kind of dealt with dodgy venture capital firms that were also not really understanding the impact dollars that they'd already raised and the purposes of them being on the capital stack. And so there is a lot of education and guidance that's required. And that's partly why I started 1.5. When it comes to technologies to come into market, even if you have a great idea, go-to-market strategy and product market fit can be really tricky, even if you had multi-million dollars in your pocket. And if we talk about ecosystem funding, the number one rule that you obviously learn if you're an entrepreneur is that you don't take every check. And money is just not the only thing that provides you impact. It's what provides it beyond that. And so when it comes to Japan or Asia region, the funding opportunities, but also these kind of ecosystem builders of the VPNs of the world, they're extremely important because entrepreneurs need to be educated about how to actually bring their products to market, and piloting with companies can be really critical. And that's partly why 1.5 started both on the finance side to help more efficiently allocate these funding with the right instruments, to actually working with the technology startups now that are at the Series A level to actually help them find their first customer and develop product market fit, rather than the capital being wasted across multiple bets and choosing the right bet to succeed.
Thanks for that, Neil. And so I think a couple of things that are quite interesting. One, I wanted to draw a parallel, this valley of death, this sort of black hole of funding that disappears within the life cycle of a business, and then consider sort of the, I guess, hidden diamonds out there that we could connect with, sort of this idea of zebras, where people can fund companies that are being overlooked by others. And so maybe Yoshi-san, maybe you want to speak to that and connect it with zebras, and Shuyin, you can come in as well with your thoughts there.
Yeah. Well, I don't know if I can directly answer to your question, but what I was really convinced by Neil's talk was you talk about the multiple level of funding, right? I totally agree with that. I think there is, so I usually use a word diversity. So it's diversity of funding is needed. I think there's two different dimensions, right? When you look at the stage of the companies, you also need the diversity of the funding depending on the stage where you are. I think that's what you were talking about, Neil. And then also there's when you, how do I say? Also, there's a width of different types of companies, right? So zebra is a different types of companies than unicorns. Maybe there's other different types of companies as well. And depending on the risks and profile of the growth, you need a different type of funding. So the philanthropy is one of the good examples, I think, that Neil was talking about. I was also dealing with philanthropic money in the past. The good thing about the philanthropic money is not just how to say it's about taking more risk. It can take more risk than commercial capital. So like you were saying, maybe for venture capital, it's difficult to take R&D risks, but if you use the philanthropic money, you can cover that risk. So that kind of different, how to say, sort of a matchmaking between the capital and the companies is needed. I think in Japan, there's probably, I imagine compared to Australia or the US, there's still a lot less diversities in the funding. Sorry, I don't know if I answered your question.
No, I think that's great perspective there. Perhaps Shuyin can chime in with your sort of thoughts on this sort of valley of death and funding these sort of black holes of investment, I suppose, or to that matter.
Yeah, I think there's a really a great deal of alignment, I think, in what we're all saying. I think we all see this, the valley of death, the missing middle, I think these different types of companies, right? And different stages of companies. And I think one of the biggest things that this theme that I'm hearing again and again, I think from all of us, is the need to take a portfolio approach, remember that it's a spectrum of capital, and really think about the diversity of funding, as Yoshi-san just said. And I think just my own reflection on this as I look back over the last 10 years or so, I think in the early days of impact investing, there was so much focus on really proving out that impact investing can generate a market rate of return. And I think we would all remember these days, right? I think it's almost like we had a chip on our shoulder in some way, right? Because I think there was a lot of skepticism about impact investing. Can you do well as do good, et cetera, et cetera. And I think now it's becoming increasingly acknowledged, as you said in your introduction, Matthias, that yes, it is possible to generate an attractive market rate of financial return and also have a positive impact, right? And I think now we're remembering the second part, right? Now that that's kind of a bit more accepted, and I wouldn't say it's fully accepted yet, but now it's a little bit more accepted. I think now we're really embracing, I think, that really exciting middle part of the spectrum, right? And some of these, alternative structures, different ways of thinking about, the different forms of, mixes of grants, debt, equity, mezzanine products, et cetera. And I think that, to me, is the really exciting place of where impact investing is now, right? And I think that's what, this appetite to take a bit more risk, right? Accept a 0% return. I think that is what's needed to really drive capital into some of these difficult places. And it's still hard. I think a lot of people, I would still say, want to have their cake and eat it too, right? Do impact investing, get a 20% plus IRR. I think we're increasingly seeing, though, that to really tackle this kind of the valley of death, missing middle type of companies, zebras as well, maybe the return profile is not quite that, right? And I think, to me, that's a really exciting problem to solve. And I think it sounds like for all of us on this panel, it is as well. But I think channeling more capital into that space, I think, is one of the big, I think, just the big challenges, and I think big stories we need to tell in the coming decade.
Just picking up on that last phrase you said, the story to tell, and the earlier point you talked about impact tracking. And I also want to mix that idea with this question of how can we increase diversity of funding in Japan? Neil, can you talk to this question about how to increase this diversity of funding and in my mind, impact tracking is one of those ways to do that. But what are your thoughts there, and how could those two ideas connect?
Can I just add one thing before Yeoh answers this?
Yeah, please jump in.
Yeah. So I think this is same for commercial investment as well. But if you only look at, say, risks or maybe risk returns, there's a tendency to that there are more companies in a later stage of the company's ecosystem, because it's obviously it's less time to grow enough and to be profitable, I would say. But there's very few players in early stage of the companies, or let's say seed stage, early stage of the companies, and it said same thing for the impact investing sector in Japan. So how do you overcome this as well? If you only think about risk return, it's more difficult to be in the early stage of the company's investors. I was always wondering about this question, but if there's no investors in early stage, of course there's no ecosystem. So there should be.
That's true.
There should be at least a number of the investors in early stage, seed stage, and then also later stage, middle stage. But there's always an unbalance in this ecosystem. If you have any thoughts on this now.
Yeah, actually, it kind of does touch on my point about how to overcome this, particularly in Japan. And or at least I can talk about it from our startups in Asia. The first thing I think, there's two things I'd say. One is there is definitely a shortage of the Shuyins of the world or Yoshis of the world when it comes to Asia. It's still quite nascent and growing. And so not everyone is going to get a cut of the pie when it comes to what's available currently in Asia. But that doesn't stop Japanese startups or even investors to look abroad as well. For one example is that Evergreen funded internationally, but a lot of our startups, only unless they came across us or knew about us, would they actually apply. And we were actually looking, and I still am firmly believing that Evergreen still wants to fund internationally. In fact, there's a lot of foundations and funding opportunities for Asian startups or Japanese startups to apply for internationally. And I think that's important for one case, because when we were funding our Asian counterparts, we were actually able to almost cross-educate or collaborate with the region as well. Because as a funder or any kind of investor, you talk to the other investors that are along the startup generally. And if there's issues, we could actually have a chat. And so that allowed us to enter in. So one specific example was China is one of the examples where things are evolving really quickly, and they're evolving their own impact investing area. But we actually funded a startup, and within that region, generally, it's recommended that if you're going to go into impact, you have a flourishing career, a profitable career, and then you do it in retirement. And so there is a lack of the older generation really encouraging young entrepreneurs to do impactful work. And so we have a lot of startups that studied in the US and then returned back to Asia to do their work. And I actually traveled to Asia as one of their funders and met one of their co-founders from the Ginkgo Foundation, where we actually sat down for a solid 2 days and cross-shared everything that we'd learned about how to sort of provide recoverable grants and the support for the ecosystem. And that kind of links to the second aspect of it. And I think it was talked about here is there needs to be almost re-education. And I think, if you think about the TV shows like Silicon Valley or venture capital, even there's that Korean show called Startup, a lot of them are pushing, again, venture capital, which has been around for a long time. And I think that it will just take so much time just to be able to sit with these startups for those people that actually really understand the space, to sit down and create this kind of re-education or this re-awareness of all these other types of multitudes of funding opportunities, and encourage companies to sort of follow the capital that's right for the impact of what they're developing, rather than just following what everyone else is. And we kind of had this concept called heropreneurship, where there is this traditional way of thinking about success as a startup, where you take venture capital money, you raise, you become a unicorn, and then you exit. I think when it comes to the impact world, we really need to think broader than that. We need to think about, like, they say two things. One is focusing more on the stakeholders rather than the shareholders, because capitalism, or at least investment capital, definitely focuses more on the shareholders than the stakeholders. And so as investors, how do you sort of hold like companies for the longer term, for their long-term growth? And then the second thing is how to, investors want pipeline, but they're not willing to do the plumbing. So how can you almost be like the Shuyins of the world, where you're actually contributing to the plumbing whilst also building up the pipeline? And so that's not just focusing on your own individual investment asset, but, being able to speak to the people before and after. And I think, even in venture philanthropy, it wasn't done that well. Like, we would fund a startup and we'd be like, here's 2 years of funding. And then they'll be like, oh, what happens now? And I think what we could have done a lot better is have spoken to a lot, or at least have better understanding of what is to come. After they finish Series A, what do the funders need? Like, how can we prepare them for that next phase so that they're avoiding that missing middle? So I think it was actually on our onus. There's a lot of solidness when it comes to investing, that it should have been on our onus to really have created that pathway also for them.
So to facilitate that diversity of funding, guiding the company along that funding journey so they grow together, right?
Yeah.
So I'd love to ask this sort of next question, a little change track a little bit, but then make sure we have some time at the end for questions. So the sort of question that I wanted to really get to know from all of you is what new sectors could we see impact in if we change how patient our capital is? Or put another way, what new areas could we see impact in if we take into account the long term and look, 20, 30, 50 years out from now? And maybe this is sort of aligning with Evergreen lands there, Shuyin. Maybe you can start us off, and then we'll bring in Yoshi-san and then Neil, and then we'll look for some questions from the audience as well.
Well, I think my short answer to your question is that I think, like, quite a lot, I would say. I mean, most impact areas, because I think, right, because it's, right. I mean, we need to be looking at these longer time horizons, right? And I think that's one of the big kind of internal conflicts of impact investing, because I think traditionally most, most impact investors, they still have had to adhere to these, 10-year fund structures. Maybe they'll go to a 12-year one, right? But it's not fundamentally solving that issue of, as you say, these are like 20, 30, 50-year type of challenges that we're addressing. So I think it's great, I'm really encouraged now to see more and more evergreen or permanent capital structures evolving. I think just really recognizing this, because I think, the other thing that we've really learned as we've been doing impact investing in the region over the past few years is that, pretty much every impact sector is long-term. Like, agriculture is long-term. And I think, Yoshi-san, I remember well, right? I mean, building out some of these smallholder farmer models in the Philippines, like or Thailand, I mean, it just takes a long time, right? To scale these types of models and really build the trust with the stakeholders, as you say, right, the community and so forth. It's not something which can be flipped in 5 years or 5 to 7 years. Building healthcare systems are long-term, building education is long-term, climate solutions are long-term, right? So I actually think my answer is kind of almost, most things that we're really, I think, passionate about in the impact space would right. benefit from longer term thinking.
Right, we're investing in the wrong stuff, aren't we? Yoshi, you want to jump in there?
Sure. I totally agree with Shuyin. A lot of I can talk about a lot of different fields, industries that needs a patient capital for longer term. But I would say, let's say a bit in the context in Japan, I will pick one of these industries. I would say education is one typical industry that needs long-term capital. If you think about what makes, how to say, what makes business, the people make business, right? What makes people, education makes people, right? And especially if you think about the education in younger children, it takes 10 years, 20 years, maybe even 30 years to, for these kids to be adult and, make, be in a society and make a real outcome. Right now, in a commercial education sector is too much focusing on a short-term outcome. So there is a commercial educational sector here, but most of them are focusing on, let's say, focusing on studying to enter in university, studying English, those type of studies, but not, people, well, for the companies, it's difficult to take a longer risk and provide a commercial capital here. So I would say education is one of the typical industries that need longer term capital.
Yeah, that's great, Yoshi-san. And Neil, I might actually save your answer for a question, actually. So in the chat, if you can put down some questions and I can cross to you, but I'd love to engage this question from Gavin in the audience. Question is, I'm not sure if Gavin, if you want to turn your camera on and give your question in. There we go.
How you doing? Firstly, thanks very much, guys, for what you've been speaking about. It's very interesting. One thing I'm actually interested in is the relationship you guys have with the founders and supporting them to understand where they are, one, either in the process, or two, where they can reasonably expect to have the biggest impact, not just financially, but potentially on society and so on and so forth. And how do you get them to be comfortable with that? Because as Yoshi just says, what is business? Business is people. And that's often something that's forgotten in the investment space. So I wonder if you could just speak to that.
Thanks, Gavin.
Yeah, I could answer that at least from Echoing Green's perspective, where I probably had a portfolio of sometimes anything from 25 to 50 companies at any given time, which is kind of a ridiculous amount, but we definitely needed more resourcing and we definitely focused a lot on people. I would say the one pro to it was that the one caveat that we had was not that we weren't spending time with the people and figuring out exactly where they should lie. I think a lot of entrepreneurship, what we did as the investor was more about their personal leadership and the coaching of their individual self and who they are and why they do what they do. And I used to think on the one side, because I used to come from commercial consulting, I was like, that seems so fluffy. But actually, mental health and the actual well-being of the individuals is just as important as them having the knowledge of where their business is going to go. Because if they're comfortable with themselves as leaders or as individuals and comfortable with why they're doing what they do, and building the community actually of these other startups around them, that ecosystem or that community of entrepreneurs becomes a lot better for them to cross-educate themselves into different ways to approaching a similar problem. Without always having to feel like they need to go via their own pathway. So I think the one thing that we did really well was building that community, which I undervalued at the time, especially now as an entrepreneur. And I understand it's difficult when you're feeling isolated, that it's really important to have other people who've kind of walked the walk. So that's the first thing. The thing that isn't so good in investing world is that it's the capacity and the capability for an investor to actually see that. And when I talk about venture philanthropy world, there is a huge mix of skill sets, but generally it's a lot more focused on the impact, which I love. And it's personally very driven by values. But when it comes to a real business and bringing that business into market and commercialization, we probably were out of our depth. So even being able to identify that that company would be a Zebra versus another company, right, is open to interpretation. And I personally obviously had an opinion, but I was one of the only few people in the venture philanthropy world that came from like commercial investing or commercial consulting that could sort of like pick up on these things, but it wasn't the remit or the focus of the investor. So I think what we could do better, and it's also in the report that we have, is that co-capacity building or that expertise ability to be able to identify these things and then like basically join the join the connections. And that's what 1.5 was really trying to do now, because we can work with remote technology, we can work at a lower cost. We're working with these Series A startups to help them identify that, because their Series A funding for climate change now is skyrocketing in the US at the moment. So these startups are raising, 2-3 million before they have like product market fit or go-to-market strategy. And so it's really critical to make sure, and we're kind of doing that work, but more so from a capacity building standpoint, is to make sure that the funders who have given this money a lot in safes or in kind of early stage, like convertible notes, that their money from these foundations and family offices are being used effectively to, as quickly as possible, find that first customer to get these solutions into market. And so we sort of see ourselves playing that role rather than the investor who is probably sourcing a lot of investments right now. So I think there could be a little bit more done from the investor side, but also from the other aspects of who else is kind of helping these startups realize this and guiding them to the end goal.
Great, thanks for that, Neil. We might just do a quick fire question from the audience here. Questions from Jeff. How could retail investors passionate about this area get further involved? And maybe this could be a wider question of how can sort of the everyday person get involved in impact investing in various levels of involvement? Maybe Shuyin, you want to jump in there?
Yeah, this is always a tricky one, because I think one of the challenges of yeah, so thanks. It's a great question, right? Because I think one of the challenges which we see is that a lot of I guess the impact products that I think that we work on are not actually available to retail investors, right? A lot of the different private funds out there. I think a lot of the retail investment products are typically more along the kind of ESG types of lines, I would say, generally speaking. I mean, I think it's obviously, and then even within ESG, some of them have more activist approaches than others, right? So I think there's again a spectrum there. Yeah, I think you can get involved in so many ways, right? So I think, so with that being said, I think that there's a lot more that we need to do on our side to create more options. But I think that being said, there still are options, right? And I think the first step is, I think just mapping up your own kind of portfolio, right? Because I think it's a portfolio approach. Definitely don't recommend you put 100% in kind of venture capital type of products. I mean, I think it's really a mix, right? And I think for each area, depending on your risk appetite, I think that there are emerging, different products to be involved, right? I mean, so more, there's now kind of, different kind of impact bond products. I mean, I think there's different, impact focused kind of crowdfunding campaigns, which are now available, right? So I think there's different options. I think what I have done personally, I mean, maybe just to speak from my own experience, is really, I think just to find, my own kind of spectrum and how much I want to allocate into each category, and then like sort products to fit that, right? I think starting with a blank sheet of paper and being like, oh my gosh, how do I have more impact? I think that's quite an overwhelming task. So I think kind of breaking it down by impact area, and I think and saying that even some of that needs to be donated, right, given away. Because I think I still, even as an impact investor, I think, as we've heard time and time again, I think philanthropy is still a really critical part of kind of of having the impact that we need to see in the world.
Thanks so much, Shuyin. And just looking at the time, I think it might be time to just start wrapping up this fantastic discussion. But let's keep this conversation sort of going. I'd like to get some concluding thoughts from each of the panelists, but at the same time, I'd love to make sure that people on the call can get connected afterwards with our lovely guests. So here in the chat, I've sent through a link which has the details of our panelists, as well as some of their great work as well. And we'll be networking. Some of us will be at the session via Remo afterwards to continue the discussion. But before we do that, we'll just go across the grounds and maybe get some concluding thoughts on the topic of catalytic change driven by impact and sustainability investing. Yoshi-san, is your home court advantage. Let's kick things off.
Thanks for that advantage. Well, it was wonderful, amazing panel. I learned a lot. I think I learned a lot. And in Japan, impact investing is still fairly new. I would say these 5 years, there's been a lot of development, but still, still 5 years. There's a lot of things to learn from different countries. Like Neil was saying, there's more precedents, examples that we can learn from. So I would like to, continue. Well, I can continue talking about this maybe for hours and hours, but
yeah, we only have one today, though.
Keeping in touch with you guys. Thank you.
Thank you, Yoshi-san. And let's throw it to Neil and then bring it home to Shuyin.
Sure. I think the thing that I would say with anyone that's here is to try to do learning by doing. There's so much wealth of information out there, but you'd be so surprised at the amount of lack of effort, and even from my side, of sometimes actually learning about other asset classes and other investment instruments to be more of a bigger investor. And just on that retail investor side, like I myself am on that journey, and I've only been able to allocate a very small portion of my portfolio right now, mainly because it takes time. Like I think that one thing that someone should have taught me was that it takes years for people to get their portfolios right. And so don't kind of be so hard on yourself when you're looking for things. You can start small and just exercise that muscle from a small way, but it does require just rolling up your sleeves, getting your hands dirty, and just going out there and actually spending the time. There is a lot of procrastination to try to see that reports will solve everything, but being able to speak with certain experts or finding the right opportunity just takes meeting the right person or just walking out there and getting it. And I think that's where I've seen a lot of success, even in the small amount that I've done in my career.
Great.
Yeah,
and
I think
Shuyin,
maybe
bring it home.
Yeah.
Thank you.
No, I think it's great. I mean, I think just building on that thought. I mean, I think for me, I think this panel was really wonderful to just to see how passionate I think everyone here is about kind of the actually achieving this impact, right? And I think yes, obviously we do have finance backgrounds, so that's an important aspect for us, right? But I think we all see that we need to move beyond the traditional plain vanilla 2 and 20 type of fund, right, to really achieve the impact that we want to see. And I think I would echo what Neil said. It's a very personal journey. I think that there's no one right way to do impact. I think it's really about, I mean, if your passion is education, then I would say absolutely focus on that, right? If your passion is climate, then that's what you should I think we'll never be able to say one is better than the other, because people always ask how do you compare this climate fund and this education fund and this women's empowerment fund? I'm like, you can't, right? I think it really comes down to the individuals, and it's a personal thing. And I think just follow your gut feeling and intuition on that.
Perfect. And on that note, thank you so much for joining our discussion for the past hour. I'd love to thank the team at Venture Cafe for helping organize this event. Lisa, of course, Tak, Ryosuke, and of course, Solana as well for being helping in the background. And of course, I'd love to thank especially our panelists for your precious time this morning or evening, wherever you are. And so let's keep this conversation going. Some of us will join the networking session at Remo where we can chat longer about these concepts of impact investing and sustainability investing to drive catalytic change. Thank you very much.
Thank you so much, Matthias, and all the wonderful speakers for this great panel discussion. As Yoshi said, I think this is really new for Japan. So that was the great opportunity to learn a lot about the impact investment, and then hopefully we can continue doing this to dive in a bit more so the community members can also benefit to learn from you all. So thank you so much for joining.